If you hold silver, this is something you need to hear. Something quietly changed in the silver market this week, and it didn't happen where most people are looking. It didn't show up clearly on a price chart, and it wasn't announced in a headline. Instead, it occurred in a part of the market that gets far less attention, far less discussion, and far less transparency. And for anyone who assumes that price always tells the full story, it's deeply uncomfortable. On the surface, everything looks almost boring. Paper silver prices continue to drift, responding to familiar macro headlines, interest rate expectations, and the usual algorithmic noise that dominates modern markets. Volatility feels contained. Analysts debate dollar strength, bond yields, and whether commodities are likely to outperform this quarter. If you stop there, nothing feels urgent, nothing feels broken, nothing demands action. But beneath that calm surface, a divergence has been widening. And it's a divergence that markets historically struggle to ignore for very long. What's unusual right now isn't that silver is volatile. Silver has always been volatile. What's unusual is that physical silver availability is behaving as if the market is under stress, while paper pricing behaves as if nothing is wrong. Those two things typically move together, or at least acknowledge each other. Right now, they're telling completely different stories. Over the past several weeks, reports from refiners, wholesalers, and industrial procurement channels have pointed to longer delivery times, shrinking spot inventories, and rising premiums for immediate physical supply. This isn't about collectibles or novelty products. This is about standard bars, industrial-grade silver, and wholesale quantities that normally move through the system with very little friction. Yet friction is exactly what's showing up. At the same time, futures markets continue to price silver as if supply is comfortably elastic. Open interest remains elevated. Liquidity appears intact. Spreads don't suggest panic. To a casual observer, this looks like a normal market doing normal things. But when physical tightness increases while paper confidence remains high, history suggests something is being mispriced somewhere in the system. One possible explanation is timing. Paper markets react instantly. Physical markets react with a delay. Contracts can be created, rolled, or closed with a keystroke. Metal cannot. It has to be mined, refined, transported, insured, and delivered. That lag allows stress to build quietly, sometimes for much longer than people expect. By the time paper markets notice, the physical reality has often already changed. Another explanation is structural. Over the past decade, silver's role has quietly shifted. It is no longer primarily a monetary curiosity or a hedge people talk about in abstract terms. It has become a critical industrial input. Solar panels, electrification, advanced electronics, medical applications, and emerging energy technologies all compete for the same finite pool of metal. Unlike gold, most silver is consumed. It doesn't neatly return to vaults. It disappears into products where recovery is often uneconomical. Public data already shows that industrial demand has been absorbing a growing share of annual silver supply. Mine output, meanwhile, has struggled to grow meaningfully. New discoveries are rarer, permitting timelines are longer, and silver is often produced as a byproduct of other metals, limiting how quickly supply can respond even if prices rise. That alone creates a fragile balance, even before investment demand enters the picture. Inventories are supposed to act as the buffer between supply and demand. When inventories are ample, shortages remain theoretical. When inventories thin out, even small disruptions can have outsized effects. Recent inventory reports from major exchanges and vaulting systems suggest that while total reported stocks may appear large, the amount actually available for delivery is far smaller than headline numbers imply. This is where things start to feel uncomfortable. Not because anyone is hiding information, but because the system itself is layered. Paper claims can multiply without requiring immediate physical backing. As long as confidence remains high and delivery requests stay manageable, that structure works. But it works only until physical demand accelerates faster than expected. And physical demand doesn't need to explode to matter. It just needs to be persistent. A steady drain is often more dangerous than a sudden spike, because it looks manageable, right up until it isn't. Industrial users don't speculate, they plan. If lead times extend, they secure supply earlier. If uncertainty increases, they hold more inventory. Individually, those decisions are rational. Collectively, they can quietly tighten a market without producing a single dramatic headline. Now layer in the broader macro environment. Central banks remain cautious. Debt levels remain historically high. Geopolitical supply chains are anything but stable. Silver production is geographically concentrated, and refining capacity is not infinitely flexible. Any disruption, even a logistical one, can ripple through availability far faster than futures markets typically price in. What this suggests is not an imminent crisis, but a growing mismatch between how silver is priced and how silver is accessed. Price reflects marginal trades in paper markets. Availability reflects real-world constraints. Those two metrics can diverge for a time, but they rarely diverge indefinitely. There's also a psychological component that's easy to miss. When prices fail to respond to tightening conditions, participants assume the signals are false. They conclude shortages are anecdotal, that substitutes will appear, or that demand will soften. Sometimes that's correct. Other times, it's simply the market being slow to update its assumptions. Silver has a long history of surprising people precisely because it sits at the intersection of finance and industry. It behaves like a commodity until it suddenly behaves like a monetary asset. It trades like a liquid instrument until it doesn't. Those transitions rarely announce themselves cleanly. One subtle but important signal is how premiums behave relative to futures prices. When physical premiums rise, while spot prices stagnate, it indicates buyers are willing to pay more than the quoted market price to secure immediate delivery. That doesn't automatically mean prices are wrong, but it does mean the reference price is becoming less representative of real transactions. If these conditions persist, one outcome is that paper markets eventually adjust through higher prices, wider spreads, or reduced liquidity. Another possibility is that physical tightness eases due to slower demand or unexpected supply. At this stage, neither outcome is guaranteed, and that uncertainty is precisely the point. What makes the current setup particularly intriguing is the absence of a dramatic trigger. There's no obvious shock, no headline-grabbing collapse, no regulatory bombshell. Instead, there's a quiet accumulation of small pressures that don't individually matter much, but collectively could. Markets are very good at pricing narratives. They are much less good at pricing slow-moving structural change. Right now, silver appears caught between those two forces. The narrative says stability. The structure whispers tension, and whispers are easy to ignore until they're not. As we look ahead, the most important questions aren't about price targets or timing. They're about resilience. How flexible is supply, really? How much inventory is truly available versus theoretically available? And how quickly can paper confidence adjust if physical constraints become harder to dismiss? Those questions don't have clean answers yet. That's why this moment matters. Not because something has already happened, but because conditions are forming that make multiple outcomes plausible. To understand why this divergence matters, you have to look at how the paper-silver market actually works in practice, not in theory, and certainly not in the simplified version most people carry around in their heads. Futures markets are often described as delivery mechanisms. In reality, they function primarily as tools for risk transfer and price discovery. The overwhelming majority of contracts never result in physical settlement. They are opened, offset, rolled, or cash settled long before any metal needs to move. That's not a flaw. It's by design. It allows producers, consumers, and financial participants to hedge exposure efficiently. But it also means the link between paper volume and physical metal is looser than many assume. A large open interest number does not mean a large pile of silver is sitting somewhere waiting to be claimed. It means a large number of financial promises exist, most of which assume they'll never be tested through delivery. Under normal conditions, that assumption holds. Only a small percentage of participants stand for delivery, and exchanges maintain enough registered inventory to meet those expectations. The system depends on predictability. As long as behavior stays within historical ranges, everything looks stable. The tension appears when behavior starts to shift, even slightly. If a higher percentage of participants decide to convert paper exposure into physical claims, the math changes quickly, not because the system is fraudulent, but because it was never meant to be stressed that way. Think of it less like a vault and more like a traffic system. It works beautifully until too many people try to use the same exit at the same time. What EL is particularly interesting about the current environment is that there's no obvious incentive for speculative longs to demand delivery. Prices haven't exploded, headlines aren't screaming shortage, and yet physical availability is tightening anyway. That suggests the pressure isn't coming from speculators. It's coming from end users and long-term holders who operate on different timelines. Industrial buyers don't care about daily charts. They care about continuity of supply. If they sense even a small risk of disruption, they don't wait for confirmation from futures prices. They quietly secure inventory. That inventory then leaves the visible system and doesn't come back quickly, if at all. At the same time, investment demand for physical silver often behaves counterintuitively. It tends to increase when prices feel boring, not euphoric. When volatility is low and sentiment is apathetic, long-term accumulators step in. They're not chasing momentum. They're exploiting complacency. Individually, those purchases look insignificant. Collectively, they can be anything but. There's one more layer that rarely gets discussed. The difference between reported inventories and accessible inventories. Public data aggregates metal across multiple categories, ownership structures, and eligibility statuses. Some silver is earmarked for specific contracts. Some is pledged as collateral. Some is technically present but practically immobile due to logistical or legal constraints. So when people look at headline inventory numbers and conclude there's plenty of silver, they may be looking at a gross figure that obscures net availability. And that's the core of the issue. The silver market may be telling two very different stories at the same time. One story says stability, the other suggests growing tension beneath the surface. History suggests markets can live with that contradiction for a while, but not forever. This doesn't mean the data itself is misleading. It means interpretation matters. Availability is not just about how much metal exists on paper. It's about the willingness and ability to deliver that metal at prevailing prices within real-world constraints. That distinction is where pricing signals can begin to distort. Futures prices reflect marginal trades between willing buyers and sellers of contracts. They do not necessarily reflect the marginal cost of sourcing immediate physical metal. When those two measures diverge, arbitrage is supposed to close the gap. In theory, higher physical premiums attract sellers, metal flows to where it's needed, and prices realign. In practice, arbitrage depends on conditions that are rarely frictionless. Metal has to move, capital has to be available, credit has to be extended. Transportation costs, insurance, financing rates, refinery capacity, and regulatory requirements all add layers of delay and expense. When margins are thin, arbitrage becomes less attractive. When uncertainty rises, participants become cautious. The result is that price discrepancies can persist far longer than textbook models suggest. Another subtle factor is the role of leasing and lending within the silver market. Like gold, silver is often lent into the market to facilitate liquidity. That metal still appears in inventory statistics, even though it has effectively been promised elsewhere. This is standard market practice, not a conspiracy, but it means the same ounce can serve multiple functions at the same time, as long as no one insists on physical separation. Confidence is the lubricant that allows this structure to function, and confidence rarely collapses overnight. It erodes gradually, often in response to small, repeated inconsistencies rather than a single dramatic failure. What we may be seeing now is simply a temporary imbalance. Industrial demand could cool, recycling could increase, new supply could come online faster than expected. All of those outcomes are plausible. What makes the current moment worth paying attention to is that paper markets are not pricing any of those risks or their opposites. They are pricing continuity. Continuity assumes that tomorrow looks broadly like yesterday. That assumption is held for long stretches of time. It is also the assumption that tends to fail first when structural changes are underway. There's also a broader macro overlay complicating the picture. Monetary policy remains restrictive by historical standards, even as global debt servicing costs rise. Governments speak about fiscal discipline, yet deficits remain persistent. In that environment, confidence-sensitive assets often behave in ways that defy traditional models. Silver sits awkwardly in that category. It is industrial enough to be influenced by growth cycles, but monetary enough to respond to trust dynamics. That dual nature makes it difficult to model cleanly and easy to misunderstand. Geopolitical fragmentation adds another layer. Supply chains are being rethought, sometimes redundantly, sometimes inefficiently. Strategic stockpiling is no longer taboo. When governments and corporations prioritize resilience over efficiency, they hold more inventory. That inventory does not show up as demand in futures markets in a neat or transparent way. The result is a situation where physical metal quietly moves from liquid pools into long-term storage, while paper markets continue to trade as if nothing has changed. For a time, both realities can coexist. Eventually, one has to acknowledge the other. What makes silver particularly tricky is that it doesn't need a dramatic catalyst to reprice. It simply needs a reason for confidence assumptions to be questioned. That reason doesn't have to be spectacular. It could be a delivery delay, a refinery bottleneck, or a regulatory adjustment. None of these would sound alarming in isolation. Together, they can change behavior. If more participants begin to value immediacy over exposure, premiums matter more than spot prices. If more contracts are held to expiry rather than rolled, delivery ratios matter more than volume. These are second-order effects that rarely trend on social media, but they matter enormously to market mechanics. At this stage, it would be premature to claim the system is under strain. It would also be complacent to assume that visible calm equals underlying balance. Markets often look most stable right before they need to adapt. The key takeaway is not that silver is about to do something dramatic. It's that the framework most people use to interpret silver may be incomplete. Price alone is not the entire signal. Availability, incentives, and behavior matter just as much. As we move forward, it helps to look backward, not for predictions, but for perspective. When you examine previous periods where paper and physical markets drifted apart, the most important lesson isn't what happened, but how it happened. The resolution was rarely clean, rarely immediate, and almost never obvious in real time. People tend to remember the outcome and forget the long stretch of confusion that came before it. In those historical episodes, silver didn't suddenly break. What changed was behavior. Small adjustments accumulated until old assumptions no longer worked smoothly. Delivery ratios edged higher. Premiums stayed elevated longer than expected. Liquidity thinned at the margins, not dramatically, but enough to make participants more cautious. And caution in market systems can be far more influential than fear. One indicator professionals quietly monitor is not headline inventory levels, but the rate of change. Sharp drops can be reversed, steady declines signal persistence. They suggest a structural flow rather than a temporary shock. Right now, certain segments of the silver market appear to be experiencing that kind of steady drawdown, though the data is fragmented and requires careful interpretation. Another subtle signal lies in term structure. When near-term delivery becomes relatively more expensive than longer-dated exposure, it reflects urgency rather than panic, a willingness to pay for certainty. That willingness doesn't always appear clearly on price charts, but it redistributes risk throughout the system. Silver is especially complex because it doesn't resolve imbalances the way many other commodities do. You can't easily substitute it at scale. You can't rapidly expand supply without long lead times. And you can't rely indefinitely on above-ground stockpiles because much of that metal is already spoken for, contractually, operationally, or functionally. At the same time, silver has a long history of frustrating anyone who tries to force a clean narrative onto it. Periods of genuine tightness have been followed by long stretches of stagnation. Episodes of excitement have faded into years of sideways movement. That unpredictability isn't a flaw. It's a feature of a market caught between competing roles. This is why framing matters. If you approach silver expecting a binary outcome, either collapse or explosion, you are likely to miss what is actually happening. The more realistic set of outcomes is wider and less satisfying. Adjustments can occur through price, but they can also occur through participation. Fewer contracts traded, different hedging behavior, shifts in who holds risk and for how long. Another possible outcome, if current conditions persist, is not a price surge, but a repricing of convenience. Physical silver could trade at a persistent premium to paper exposure, not temporarily, but structurally. That wouldn't mean futures markets are broken. It would mean their role has narrowed. There's also the question of regulation and transparency. Market structures evolve, sometimes in response to stress, sometimes preemptively. Reporting requirements change. Classification rules adjust. None of this needs to be dramatic to have an impact. Even small regulatory shifts can alter incentives in ways that ripple outward. Geopolitically, silver occupies an uncomfortable position. It's essential enough to matter, but not strategic enough to be headline protected. That makes it vulnerable to policy blind spots. Trade restrictions, environmental regulations, or energy constraints can all affect supply indirectly, without ever mentioning silver by name. Then there's sentiment, which almost always lags reality. Most participants anchor to what has worked before. If silver has been range-bound for years, people assume it will remain so. That assumption becomes self-reinforcing until it doesn't. Disruption doesn't have to be dramatic. It just has to be persistent enough to make old heuristics unreliable. What's notable about the current moment isn't widespread fear. It's the absence of it. Attention is elsewhere. Capital is chasing more exciting stories. Silver is treated as background noise. Historically, that's when structural changes have the most room to develop unnoticed. None of this guarantees an outcome. It doesn't predict timing. It doesn't insist that the divergence we're seeing must resolve through price. It simply suggests that the market may be accumulating unresolved questions. And unresolved questions tend to demand attention eventually. If paper prices continue to lag physical signals, the gap between perception and reality widens. At some point, participants have to reconcile the two, either by reassessing availability or by reinterpreting price. Which path it takes depends on variables still in motion. The uncomfortable truth is that silver often moves when the fewest people are prepared for it, and in ways that satisfy almost no one's expectations. That's not a forecast. It's an observation drawn from long, messy history. For now, what matters most isn't conviction. It's awareness. Understanding that calm surfaces can hide complex currents underneath. That markets don't need villains or secrets to behave strangely. They only need incentives that no longer align perfectly. The silver market right now appears to be asking a quiet question. What matters more, the promise of metal or the presence of it? That question doesn't need to be answered today, but it rarely goes unanswered forever. And that's where we'll leave it, not with certainty, not with conclusions, but with the recognition that something subtle is unfolding. Whether it fades or deepens will depend on forces still playing out, mostly out of sight, and mostly in places price alone cannot capture.